Underestimating shorts as we move into S&P land for Tesla can be very unwise, hence the 300-point drop today in Tesla's stock price. This is Greg for Teslafaninsight. Thanks once again for joining us. As we shared, if there's significant news happening, we'll definitely try to cover it to make sure that you're well informed. So what I wanted to review this afternoon is the fact that, yes, Tesla stock was up great this morning. It was awesome to see it in the high numbers near $1,800 a share. The challenge, obviously, is that number fell back as the day progressed. And so I wanted to sort of review a few data points related to this that we want to be aware of as we're moving through this powerful movement at stock time for Tesla. The first item that I want to review is most of our viewers are managing fairly large portfolios, and in a lot of cases, they're working with discount brokers. Now, what's amazing to me is just the fact that usually once you go past $1 million, $2 million, $3 million in your account, you feel confident because of the environment you've been previously working in. But one of the challenges that lurks there is that there are disadvantages that lurk with sticking with one broker, and good fundamentals dictate certain modifications in how you do business, particularly as your account size gets bigger. So let's review a few good fundamentals to be aware of. Number one, really good idea to consider stop losses. You could do puts as a way to cover the opposite side, but by doing stop losses, maybe 100, 150 points out of the money from where you are is a good idea. And as stocks run, you may want to put those stop losses in systematically, changing where they're located so you capture all the value that you've made rather than giving it all back. I'm guilty of that today as well, because I actually thought end of day we'd get a nice push up that would address the losses that occurred today. The second thing to note is that selling order flow. So there's a gentleman named Mr. Krell, and he actually has done he's a trader. He's taught people how to trade. He has his own trading academy, and he's a former Goldman Sachs and a trader at a number of firms. And one of the things that he pointed out that I totally agree with is the concept of selling order flow. So what happens if you're a discount broker facility? The trades that are going to the market aren't executed by those firms. They sell their order flow to these large entities. So when they do that, the issue that pops up is that you now have a situation where the enemy that's battling to put you out of business and take away your money is actually becoming the entity that's completing your trades. So this process gives them a number of advantages over you. Number one, they know the type of trading you're doing. Number two, they know your positions in terms of what you've bought and sold. Number three, they have a sense for when your stop losses are there. So there's all this information they have. And what they can do is collect that information across a large number of investors that are coming from the discount brokerage world through their firm, and then craft solutions to actually bury or cause as many of those people to lose money as possible. So one of the ways to mitigate this is, as your portfolio size gets larger, it's a headache to open up a second account at a non-discount brokerage firm if possible. But what it starts to do is break up your order flow. So now you get information from large firms. I would say Schwab is another option, but I'm thinking, if you're dealing with Goldman Sachs or Morgan Stanley or some of the other firms, you get good execution, but you also have your money split between two places, and you're looking for types of things to validate that choice, like better executions, and importantly, not giving away information about your order flow as you do trades, and you get the benefit of experienced traders in these organizations supporting what you're trying to do. So it's really smart that you've been saving on commissions by staying with your brokerage, your discount brokerage plan that you're doing, But on the flip side, there are drawbacks to it in terms of the fact that you're at a disadvantage to the best traders that are within the large firms by you not using those large firms to be on your side rather than operating against your interests. So for me, that is a given. As the size of your portfolio increases, it's a really good idea to have at least one other firm, if not two other firms, that is handling your trades, because there's market information flow you particularly get from market maker firms that you won't get from discount brokers. I can tell you I have an E-Trade account, and if I have to do something, it can take me between 1 and 2 days to get a call returned or any questions answered. I really feel that it's great prices, it's easy to do it online, but I really need to change up how I do business, because I actually get better execution conversation-wise from Ameritrade than I do from E-Trade. But there are drawbacks like selling your order flow that actually screws up your best interests as you interface with those firms. Definitely something to think about in terms of the process that you're doing. The other thing I'm impressed by, at least with E-Trade, and you'll find with other firms, is, for example, there's something called a put spread and a call spread. There are other, or selling puts, or there's just a number of different instruments that are out there that you can utilize as you're making money to sort of generate cash in this environment, and it can be beneficial to have people you can talk to. The other thing that was pointed out to a friend of mine I thought is totally amazing is that when you do a trade, let's say on Ameritrade or E-Trade, look at the bottom of the screen and you'll notice that it tells you what the commission is. Well, guess what? That commission number looks really low, and you're thinking to yourself, oh, baby, I'm getting this done for a very cheap commission, which is kind of true. That number is low. But the thing about it is, when you sell your order flow to another firm to do the trade, you're actually getting slightly screwed. And the reason is because the VIG, or the bid ask, the fee that's being gotten by the organization that's clearing your trade can be 10, 20, 100 times bigger than the trade price they're giving you. So you're, on one hand, getting a cheap trade, but on the other hand, the spreads that you're getting suck. And those spreads that you're not getting paid on, it's a disaster for you in that process. So I think you want to be aware of these. There's something I've had in mind, about my show for a while, and I'm looking for comments from the good friends that I have for the show, in the comment section afterwards, which is, there's a thing I always hated about school, which is most schools teach on a bell curve. The idea is that I want to teach at the top of the bell, not at the either end, because I don't want to lose everybody. So the people who are novices will be barely understanding what I'm saying, managing their portfolios. The people on the other end will be sitting there going, man, this guy doesn't know what he's doing, because the complexity of what he's doing is not at a sophisticated level. And I agree, I can go sophisticated, but the problem is I lose all the people on the other part of the bell curve. So I kind of bring this up to you because what you'll notice in my show, and is kind of going on today, is that I'm reviewing things I've covered before for those who've seen it before. But what I'm also doing is saying that what I want to do on the front end of my shows is to try to keep the conversation at a fairly basic level. And then at the back of the conversation, I would want to get way crazy in terms of complexity, because I don't want the people on the front end to get lost, and then we get to the back end and they're nowhere in the conversation. But at the same time, I don't want people to get bored because there isn't quality information that's being shared. So this is a challenge, and I'm hoping that the questions that I get from you help me to do a better job of addressing people that might be at the front end, middle end, or back end of a conversation, or less intense, more intense, greatest intensity. I don't want to do that. And so what it suggests then is, if you're a sophisticated trader and you want more sort of meat on the bone, you probably want to wait until the back half, because then I'm going for it in terms of trying to introduce concepts that are complex and do them quickly, and make sure that I try to do a good job of providing information that's in depth and high intensity. So this brings up my intensity point for today. So I'm going to call this Trade X, and I wanted to articulate the fact that, like, there are different people that watch my show. Some people are brand new, some people have been here a long time. What I've had fun with is watching different people tell me about pinning days and things like that that we've talked about a lot. And it's thrilling to see that A, you hear what I say, B, you're paying attention, and C, you're implementing the things I'm talking about, which is great. So, for example, we've discussed numerous times what a pin is. Today, I believe, was a great pin. So I wanted to say today, in general, there's a lot of money at stake here in this next couple of weeks. And for you and I not to expect dirty tricks that tanks the market so that the shorts can make more money, I think that's unwise. Those guys are smart, and there's a lot of money at stake, so they're going to protect their interests by trying to bury you. So how your process is structured, and if it's structured well, those guys don't have a chance because you're not leaving yourself open to get blown out. So there are examples that come to mind. Number one, if you're going to buy calls and puts, try to go out a week or two, if not 3 or 4, if you can afford it. Why? Because you're using time as a hedge. Do the stop losses. Get a put that's way out of the money. Yeah, you're going to lose money on the put, but instead of focusing on losing money on that put, look at the idea that on the call side, you're looking at all that gain that makes up for a little put that you've put down there, because those guys know when you have no coverage on the back end. The thing about it is that I just got a comment that says, complexity-wise, the show has been fine. The issue that comes up is that when you're looking at a show, you're thinking of it in terms of your command. So if you're a novice, it might be too fast. If you're an expert, it might be too slow. There's just a lot of folks that watch the show, and we want to try to do a good job for each of you and make sure you make money and you have some fundamentals in your process that allow you to make more money. That's our goal. So other things that I wanted to cover here include the fact that expect the other side to work as hard as possible to bury you. So as you're making decisions on trades and structure and how much time you're putting in and whether or not you have a stop loss or a put in place, think about the fact that once you've structured a portfolio, if a hedge fund or the other side of trades wanted to bury you, have you set yourself up to get blown out? By not having good fundamentals in place that allows you to control your downside while you're making money. Good thing to think about. So one of the things I'm hoping for right now in this part of the show is I love it when I get to review what I call classic trades that are excellent teaching tools, okay? And so I'm going to call this Trade X, and there's going to be Trade X1 and Trade X2 and Trade X3, etc. So what I wanted to review with you as a Trade X, because it's just so beautiful how they did it. Trade X for me is a trade that you may recall if you're a Tesla holder. What happened was great numbers came out on the last quarter, and it was a Wednesday, just like we're going to have this time. What ended up happening is Elon made a comment about the stock being too high, and Mr. Einhorn made an insinuation that the accounting principles used by Tesla were illegal, and therefore it should be banned, or was suggested Tesla was a questionable organization based on accounting principles used. So what I wanted to review with you here is I love the trade, and I call it Trade X because it was pied de résistance en français. It was such a good trade. It cost a lot of people so much money that you have to say, these guys deserve an Academy Award for great trades. This is a great one. So just to review basically what happened in Trade X, Tesla announces earnings. It's 2 days before expiration. The earnings come out great, stock starts to run. All of a sudden, Mr. Einhorn makes his comment, that tanks the stock by 50 to 100 points. Then Elon says the stock price is too high. And that does the coup de grace that brings the stock down 150 bucks. And so what I was really looking at, actually, that happened and people lost money on that one, but that actually wasn't the Trade X I was thinking about. The Trade X I was thinking about is what happened was Tesla had run up to 961, And there was a process that some hedge funds used to drop the stock from 961 to below 750. And the process took about 3 days. And so basically what happened was there was a technique that was articulated, and we did a show about this that you might want to check out. I'll try to put the link in. But what they did was there was a gentleman who had managed to purchase $1.5 million worth of calls on Tesla. And the calls had been purchased 6 months in advance. And so the firm that stood to lose a huge amount of money, their traders put together a battle plan to bankrupt this dude that had this huge windfall coming to him if Tesla was above 750. So they explained that there were 3 rudiments to how they got this done. The first was they put out a bogus news story on Marketplace with a negative tone to it. Number one, that started the stock sort of rolling down. The second thing that they did was they knew where the stop losses were. In this case, it was at 900. Stock was at 961. So the negative story sort of put the idea out there, oh, there might be a problem here. Stock starts to roll down. Stock crosses the 900 mark. Then what happened was another brilliant move. What they did was the company entity in question went out and borrowed 2 million shares of Tesla's stock, and they sold them at something like a $10 loss. So the combination of the negative story to get the stock price moving lower, the second element of this was getting the stock past the stop losses, and so they triggered a further selling. And then by them selling 2 million shares at a lower price, you now had a triple whammy occur where all these different items started rolling Tesla's stock price low. So the stock went from 961 to 720 in something like 24 hours, despite there having been terrific news on Tesla that had forced the stock price up there in the first place. So here's an example of beautiful process. The reason why this is beautiful is because what happens is the other component of this is the reason they bought the 2 million shares and sold them was because they're going after the bots, meaning that many hedge funds have bots that even if they're not individuals that are selling immediately on a stop loss, the bots will sniff out this downward trend in the market based on news, and they'll sell too. So all of a sudden you have all these different entities start selling at the same time, and nobody knows what the news is yet that's driving this, but the answer is, who cares? I need to get out now, and then if everything's fine, we can come back into the stock or stocks that have been jumped out of to avoid disaster that might hit. So this is an example of great technique in trading that even for a great company that can occur. So if you're truly a friend of our show, we want you to know Trade X backward and forward, because each rudiment of how this works is great for you to understand, because as it's occurring, if you have the courage to buy into these dips that are introduced by the hedge funds, it's a chance for you to make a killing on the other side of some of these trades. So I may review this again, but I notice a lot of you know about the 3-day rule and pinning, but the Trade X thing is terrific because I really think today was a Trade X. You know, Tesla was down, but the fundamentals of why Tesla's where it's at is still there. Yes, the NASDAQ was down, and you do need earnings to really solidify everything heading into the S&P. But I think it was beautiful technique by the hedge funds as a way to lower the price so they can get out or get in if they're on the other side of it. You know, that's just good trading technique. So if you're going to be in this game and be hardcore and want to make money, you have to be ready to think through how all the process works. And you may have to consider buying the dips because, and perhaps, you know, hedging yourself or something of that sort. So I'm being long-winded here, but the goal is the better informed you are, the more money you can make. And if you're uninformed, they can take advantage of your lack of knowledge or understanding of how all this party really works. So finishing up here today, in general, I'm disappointed by the stock dropping like it did. I don't think the fundamentals have changed. Company's doing well. You know, the bot exit makes sense because once the bots sell out, the managers can then come back in and say, oh, it's down. This is a better buy for us, and we got out at a decent price, so we saved a bunch of money away from going to the bottom, and we can buy back in comfortably to have a position at a better price than we would have otherwise. So these are some things to consider process-wise on how you can trade better and make more money in the process. So show's going a little bit longer than we usually do. I apologize for that. We want information to go out that benefits you and helps you in your trading process to make more money. So don't forget, come on, open up a second account. Make sure you have some stop losses in there, or you're using puts as a hedge against loss as a way to address this. Bigger portfolio, consider, slicing it in half, maybe discount broker on one half, large bulge bracket firm on the other, as a way to give yourself a window inside of what those guys are doing at those firms that might benefit you process-wise. So we'll include other things in this process, but you can see how the trajectory of the show went. Fairly basic front end, we have a middle and the back end, a little bit more complex in terms of how it works. And we're eager to hear your comments afterwards, et cetera. The reality is that, I was talking with someone today about what I call the jacket theory, and that is that, hey, I like saying stuff that's good fundamentals and that makes sense. And so even if you don't like me, that's fine. I like to think about the fact that we're hunting good fundamentals and sharing those. And if you don't like them, that's cool. You don't have to watch it. If you do, it's great if you benefit from applying those fundamentals to your portfolio and making good money or more money in the process, and potentially not getting blown out or abused. So abused by the hedge managers who are short or who want to use their expertise to demonstrate that expertise to you in terms of trying to crush you. So any rate, very interesting trading day, great learning opportunity in terms of good management process. I'm really intrigued by what's going to happen tomorrow, because there's some great stocks like Amazon and some others that got mashed at the end of today, and all their fundamentals are in good shape. So I'm eager to see what tomorrow looks like, because the process is, oh, something crazy happened, let's run for the exits, and then, oh, the craziness is over, really, and it was just great trading technique. Let's come back in. So you'll notice with Tesla's stock price, you're seeing these dramatic up and downs recently. And as we head into higher numbers for Tesla, I expect it to happen more, because there's a lot of money at stake, and great traders can leverage their position of information against you in order to jack you. Any rate, I'll work to answer the questions afterwards. We're sort of beyond our usual time here, and we appreciate the time you share and try to make sure what we present, fits, great timing and process and input. At any rate, this is Greg for Teslafaninsight. Thanks once again for joining us. I just want to remind you to like and subscribe if you would. Tschüss, German, au revoir, French, Lehitro, Hebrew, Hoda, Hafez, Farsi, Hey Do, Hey Do, Zdravstvuyte, hello in Russian, Ni hao ma, hello in Chinese. And I want to just say good luck on your trading tomorrow. Thanks for joining us once again. We look forward to getting a chance to sort of compare notes and come up with better ideas that help us all make more money in the process. Have a great day. Bye for now.